How is depreciation measured in economic investment? Imagine you buy a machine today to help produce goods. Over time, that machine wears out or becomes outdated. How do economists figure out how much its value drops each year? That's what we call depreciation. In economic investment, depreciation measures how much the value of physical assets like machinery, buildings, or infrastructure decreases over a period, usually a year. It reflects the consumption of capital goods used in production. This is important because it helps us see how much of the total investment actually adds to the economy's productive capacity. To measure depreciation, economists start by estimating the total value of the capital stock. Think of this as adding up all the physical assets that help produce goods and services. They look at past investments and adjust for how much those assets have worn out or become obsolete over time. Next, they apply depreciation rates, which are percentages that show how fast different assets lose value. These rates depend on the type of asset and how long it is expected to last. For example, machinery might have a depreciation rate of 10% per year, meaning it loses 10% of its value annually. There are different ways to calculate depreciation. One common method is the straight-line approach, where the asset's value is spread evenly over its useful life. If a building costs $100,000 and lasts 20 years, the annual depreciation would be $5,000. Another method is the declining balance, or geometric depreciation, which assumes assets lose more value in the early years. For example, a piece of technology might depreciate faster in its first few years due to rapid obsolescence. Once depreciation is calculated, it is called the consumption of fixed capital. This is the total amount of asset value used up in a period. It is subtracted from gross investment to find net investment, which shows how much new capital is added after accounting for wear and tear. This process is key in national income accounting because it adjusts gross domestic product to reflect the true increase in the economy's productive resources. Different assets have different depreciation rates based on their durability. For example, vehicles might depreciate quickly, while land does not depreciate at all. Agencies like the U.S. Bureau of Economic Analysis use specific assumptions, often geometric depreciation, to estimate these rates. They rely on historical data, engineering estimates, and economic models to assign appropriate rates for each asset class. In summary, depreciation in economic investment is measured by estimating how much the value of capital assets declines over time using specific depreciation rates and methods. This measurement helps economists understand how much of the investment truly contributes to the economy's growth and productive capacity. It is a vital part of national income accounting because it provides a clearer picture of how resources are used up and replaced in the economy.